Hi traders, Nathan Bray here from ACY Securities, and I'm happy to introduce to you our new 5-part education package where we're going to introduce the 5 topics that I believe are essential for you to know if you're looking to do price action trading, technical analysis, or even just using charts to derive your decisions for entry, exit, and management. Okay, what are the 5 things you need to know? So I'm going to be covering, number 1, folks, is trend. We're going to very briefly talk about trend. We'll even do it at the end of this video today. Okay, so people understand why it's so important to your trading and also how you can use it in your trading, okay? Number 2, I think you've got to get your head around support and resistance on multiple time frames. You've got to understand the importance and which time frames hold more credence. Okay, so when we're buying, we're not buying into this massive wall of resistance or selling into a wall of support. So how do we identify them? Okay, number 3, when we're trading in line with the trend with, say, support and resistance levels, we want to make sure that we're buying after a significant pullback, whether we're looking to buy or a pullback to the upside to sell. So we'll cover Fibonacci retracement zones, okay, and how to use them in your trading, okay? So for me, when I'm trying to isolate levels in the market, I'm using these 3 things, but I'll put them together. So when I get a confluence of agreement between these elements, I can isolate zones that I've done in advance. A lot of traders will sit there and say, oh, wow, look at the chart yesterday. They're looking back and saying, I should have been a buyer, I should have been a seller. What we're doing is saying now you should be able to be forward looking, isolating where on a chart I want to be a buyer and a seller in advance. Now, I'm not suggesting price will get there, but what we're doing is using a confluence of reasons, okay, using both trend, support and resistance, and your Fibonacci levels in conjunction to find the best looking opportunity. The next thing is, what will be my trigger to entry? So that to me is number 4. Let's talk about triggers to be able to identify whether or not this level could potentially work, okay? So what are the triggers to enter a trade? So I'll go through and explain why they're important and what examples are and what they may be. Finally, once we're in a trade, I want to talk about risk reward, okay? Making sure that when the uncertainty of the market plays out, I'm in a position where I can maximize my gain and minimize my risk and do it over a whole number of trades. In essence, by the end, we're going to be creating a price action trading plan. So multiple reasons to isolate the opportunity. When am I going to enter? And then what happens when I do enter? So this is what we're going to cover in these next 5 training modules. Now remember, these are free of charge, okay? We're not charging some exorbitant amount of money for education. What we are doing is providing it to clients in conjunction with either a trading mentor at ACY like myself or one of your account managers. So your account manager can assist you. So often we'll go through each stage, set you a little bit of homework and say, all right, now let's focus on number 1 or number 3, whatever it is. And let's go away and make sure we've got our head around what that means. And then in the end, we're going to bring it all together. Okay, we're going to show you how to bring the whole thing together and send you away following a particular strategy. And then what you can do based on the time you've got for the market, based on the number of times that you can watch your trades, based on the type of trading you're looking to do, whether it be in and out day trading in a few hours, or whether you're looking for longer term opportunities, we can then customize this package to suit the type of trading you're wanting to do. And again, it's all free of charge. All you've got to do is register your live account where you'll be allocated a trading mentor or account manager, and they'll be able to walk you through it. So to start off with, folks, to finish off today, let's talk about trend. A lot of people think they understand trend, but let's start there and look at this US dollar index and make sure we're understanding what uptrends are, what downtrends are. Okay, so to look at the properties of an uptrend, we're going to be using the US dollar against the Japanese yen, and we're on a weekly chart here. Now keep in mind the properties for an uptrend, and then I'll show you a downtrend, are both going to be the same regardless of the time frames that you use it on. So you could do it on a daily uptrend, and you could do it on, say, a 4-hour. You could go all the way down to the shorter time frames as well. The properties and the identification is going to be the same. So let's start here. I've sort of painted in, based on where price is here, the most recent top and bottom, okay? Because the property for an uptrend is what we're looking for, is seeing the market tell us that it's putting in a higher high and then a higher low. All right, so I'll show you that structure. So right now, price is sort of in the middle of its most recent high point and its most recent low point. So let's now move the chart across. Now you can see here, technically price breaks that level and goes in and puts in a higher high. So technically that therefore is the start of a weekly uptrend. And if we now move across, you'll notice that price certainly does break through there the next week and goes higher. All right, so we'll paint that then in. So it's put in the high high. And as we move across week after week, you notice that price then comes in and puts in what we call a higher low here. So it is higher than this previous low. So we've got a higher low formation and a higher high formation. Therefore, that is the definition of what we're looking for in an uptrend. And finding a trend is useful in a number of ways. It gives you an initial bias towards the way price is being used. But at the same time, as we move ahead, we start to find that we want to almost trade in line with the direction of a confirmed trend, for the simple reason, as I go ahead months and months ahead, we start to see that the moves up, okay, can be quite significantly greater than the moves down, okay? So, but we're expecting corrections, we're expecting profit taking, we're expecting moves down. But if I was to be a seller, then I might have the potential for a month down here where price is only going down 500 pips. Whereas if I was in this particular move, okay, then price would have already gone up, 1,500 pips. So you start to see the advantage of trading with the trend or not swimming against the tide. So therefore, an uptrend, that is the clarification there, all by the definition. So you'll see these low points. I'll just paint them in now for you. And as we move ahead, you start to see they're all putting in higher bottoms. And of course, we could paint in the fact that it's putting in higher tops. So that's what I want to do when I'm looking at a chart. I'm literally looking at it to quickly gauge the direction based on the time frame. Is it in an uptrend? Now, if we were looking, this time we'll look at, say, perhaps the US dollar index. So I'll show you that to give you an idea of how a downtrend functions. So let's just move this chart to the side. We'll do exactly the same thing. So the biggest difference here is, rather than an uptrend, we want a higher bottom and a higher top. In a downtrend, it's basically flipped on its head in that we want a lower bottom and a lower top. Okay, exactly the same scenario. Let me show you. So if we were looking at price right now, and remember these dots that I'm using that you'll see here, it's purely an indicator to show you easily where the most recent top or bottom is, and it's certainly an indicator that people can use as a guide. Okay, now let's have a look at a downtrend. So I'm using the US dollar index. So you can see here, it's a similar scenario. I've used these dots, which is just an indicator to show you where the most recent high or low is, and it can often be used when you're looking for support and resistance levels as well, which we'll get to in our next session. But right now, I want to talk about a downtrend formation, which is we're putting in a lower top and a lower bottom. So basically the opposite of an uptrend. So right now on a weekly chart on this US dollar index, we can see that price is pretty much in the middle of the top and the bottom here. So as I move across week by week, price is moving around, but it isn't putting in a higher top, or it isn't putting in a lower bottom at this stage. So we keep moving sideways for about a month or so now, and then all of a sudden, oh, it gets so close. But technically, you would say price did get below and put in a lower bottom, okay? But even if you're waiting for confirmation for a close, which is up to you, you'll notice that it happens right here. So suddenly this week closes below and puts in another lower bottom. And if we therefore look to the top, we see that it's actually a lower top. So the lower top is in green and the lower bottom I've painted in green as well. So in effect, as soon as it breaks and puts in that lower bottom, that by definition is the start of a weekly downtrend. Now, as we continue to move forward, we're looking for further lower tops. But the issue is that a lower top could just be a consolidation period. It's hard to judge until we get another lower bottom, which we get here. So you end up then looking back and saying, okay, that's another lower top forming, and breaking through the current lower bottom, we get another lower bottom forming. So we're able, by looking at this chart, to say the trend is in a downtrend by function. Again, when we look at the downtrend and we continue on, we start to see that the moves down are quite significant, and the rallies that you're going to have, whether they're profit-taking rallies or uncertainty in the market or news events, whatever it is that's causing it, they're a lot smaller than the move down. So again, we don't want to swim against the tide. We want to swim with the tide, okay, when we're trading, because it could provide potentially, if we're trading with the trend, greater profitability, whether we're trading the trend in an uptrend or whether we're trading in a downtrend. And I think based on the timeframes that you choose to trade, picking a direction and using trend as one of the first elements to have a bias towards trading, whether it be up or down, is essential, okay? The other thing you can have, of course, is what we call consolidation, where price is neither in an uptrend or a downtrend. And you can see for a little while that can occur. And of course, those are very easy to see. You get neither higher tops or neither lower bottoms. So very simple process. But folks, to start off in this session, understanding an uptrend and understanding a downtrend, I think, is one of the most important elements. And for the rest of our training modules, we're going to start to add to it. So we're not just going to use trend alone. In the next session, we're going to go through support and resistance and start to see how we could use that in line with trading with a trend.